Hello everyone, thank you for tuning into OptionGig. This is your host Vivek Somani, and I am here to present you the summary for the week starting from 2nd of March to 6th of March. And then we will get into our trade summary, we'll talk about some mailbag questions. So a lot of things to cover, and we'll do all that right after this introductory music. So stay along, don't go anywhere. Hello everyone, welcome to OptionGig. This is your host Vivek, part-time option trader and full-time worker, husband and father. If you also want to generate consistent monthly income trading options while working in your regular day job, then join me in this journey. Alright, welcome back. So let's dive right into it. As always, let's start with the market making news first. The first news, and that's been happening for I think a couple of weeks now, is coronavirus. And the virus continues to weigh on US stock markets. We saw that markets were very volatile because of uncertainty around the long-term impact of what this virus could do to the economy. And also, the number of confirmed cases in US kept on rising. As of now, we have more than 310 cases and the total death is 21. I guess maybe at the time of recording right now, it is probably 22 or 23. I just prepared the deck yesterday and the numbers have been changing every day. But the more worrisome concern is that now the cases are being reported from newer geographical locations. So we do understand that it has been spreading within the community. And I think that's what is causing a lot of worry in the market. And now, because of these worries, Fed, as always, is trying to come to rescue of economy, or in this case, maybe to the rescue of the market. So in response to coronavirus, US Fed cut the interest rates by 50 basis points. Now, there are two camps around this whole interest rate cut. Some people think that it is good because it will make the loans cheaper for those businesses who have suffered because of this coronavirus. On the other hand, there are other campers who say interest rate cut is not going to get people back into the office. It's not going to get people back to attending events. It's not going to increase the travel by folks. So it's not going to help in medical issues that this virus is creating. So it won't help much. And something that Fed had used its bullets too soon. Because at this point of our time, we really do not understand how big the problem is. But anyway, it did little to stop the bloodbath in the market. There's nothing much that changed in the market. And because the market kept going down, people kept on piling on bonds as a safe haven instrument. That led to fall in the 10-year treasury yield, and that fell to all-time low of just 0.7%. Imagine someone locking their money for 10 years at a yield of 0.7%. It's a new low. So if your portfolio was a little diversified and you had bonds rallied, and that's what caused the fall in the yield. As you know, the price of bond and the yields are inversely proportional. So if bond prices rise, the yields fall. Only good thing that could come out of this for retail investors is if you're having mortgage, you could refinance it at a lower rate. Or if you want to, let's say, buy a car, etc., you may get the debt a little cheaper because of fall in the treasury yields. Most of these mortgage rates as well as some of these loan rates are tied to 10-year treasury yields. So if you're looking to refinance, maybe call up your mortgage broker. Next headline I want to talk about is that markets were extremely volatile. We had some days where the markets were up, some days the markets were down, but if we really look at a week basis, this is the first time that S&P 500 had gains and losses of more than 2% from Monday through Thursday. On Monday it rose 4.6%. Tuesday it fell down 2.8%. Wednesday it again rose 4.22%. Thursday it fell down 3.39%. Okay, Friday was no better, it fell down 1.71% only. But it's the first time in S&P history that we saw a swing of more than 2% for 4 continuous days. That tells us markets are extremely volatile. It's very difficult to pick direction at this point of a time. And lastly, I want to talk about is jobs. Yeah, that's a silver lining in these dark clouds, is that the job reports in February still showed strong growth in the job market. Employers added 273,000 jobs in February. That means unemployment rate ticked down back to 3.5%, which is the lowest in 50 years. We had seen this unemployment rate back in December 2019, and now it's back to that level. But it did little to change the sentiment of investors or traders in the market. And now looks at how the market indices perform. So S&P 500, it opened the week at 298.21 and closed at 297.46. Again, a decline of 0.75 units or 0.25%. Dow Jones Industrial Average opened at 256.71 and closed at 258.85. Yes, the Dow Jones Index was in red throughout the week, but in last 1 hour on Friday, it eked out a small gain of 2.14 units or 0.83% for the week. That's what the last hour did to Dow Jones Index. Now the technology sector QQQ opened at 208.76 and closed at 208.02. Not much change. A change is only negative 0.74 or down 0.36%. So almost flat. IWM, small cap index, opened at 147.97 and closed at 144.40, means change of 3.57 or 2.41% only. So this is how market indices perform and the broad market indices. Now we will get into the summary of how I did in the last week. Pretty busy week. Totally I closed 25 trades, including the trades that have been rolled out to further exploration, means close the current month trade, open a new trade for the next month, get some more credit. In those cases, because I had to close the current month trade, I might have closed them on loss, and those appear as losing trades. The trades that I closed for profit appear as profitable trades. So totally I closed 25 trades, 14 were profitable trades, 11 were losing trades. So win rate is 56%, and overall I opened 42 new trades, including the ones that were rolled from March to April expiry. Alright, before we get into the details of the trades, let's look at thought of the week. With all what's happening in the market, it is very difficult to stay sane and to continuously push for our plan. So the thought that I want to talk about today is, when the going gets tough, the tough gets going. If you have just entered into the market, you will be rattled by what we have seen in the markets for last 2 weeks. And I don't want to downplay the significance of what's happening around us. Coronavirus is a human tragedy, and I think we as a human race will get through it. So this whole market downturns is temporary. Now, how long this temporary phase will stay, nobody knows. The best brains in pharma industry, the best brains in technology, and the best people around the world are working hard to find a cure for this. But this is not the first time that we have seen. We have seen that a calamity strikes. We as a human race are engineered to get through it. Now, the bigger question is, are you still willing to stay and hold on to your thesis of long-term investing if you are, or your thesis of selling options in the market when the going is getting tough? I know it's not easy to stay sane in this period when the S&P is going up and down 2% every day. You see the huge swings on in your portfolio every day. It takes a toll on us. But I think we just need to get through this, and we'll all come out much better when this is all said and done. Okay. All right. So next section, I want to talk about the trades, getting into individual trades. So trade leaderboards. As always, let's first look at the trades that were profitable. Because the market has been going low, I was trying to close as many, at least the short call trades as I could for profit. So the first one that come up is our short call on Green Dot Capital, ticker symbol GDOT. We had opened this trade on 4th of February. We have 300 long shares in our portfolio. So it's kind of a covered call that we did. We got a decent premium of $2.45. The stock was trading at $33.40. So we opened a $35 covered call. And with the down move in the market, stock actually fell down to $29.84. So with this down move, we were able to close this trade at almost at a fat profit, and it gives a return on capital of almost 23% in 31 days in trade on the option side. Now I still hold these long shares in my portfolio. I am long-term bullish on this. So, but to reduce the cost basis, I will sell another covered call now for a future dated one. But for now, we close this at a really handsome profit. The next one I want to talk about was a short put that we rolled up. So that means we closed the current short put and open up a higher short put. The ticker symbol is TDOC. Company is Teladoc. So I'm bullish on this company. So I had a short put at $95, and Teladoc is in the business of telemedicine, and because of the coronavirus, a lot of users or their customers would rather stay home and talk to doctor and not go to hospital. So everyone, investors and traders, were bullish on this. So that caused a huge run up in the stock price. So I rolled up the 95 put over to 105 short put. So closed the 95 put and opened up a new put 105, and we got a handsome $292 profit for doing that. When we opened the trade, TDOC was trading at $131.35. When we rolled up our put, the stock was trading at $136. Okay. The next one I want to talk about is the Stone Co. Ticker symbol STNE. We had kind of a jade laser trade on it. Means I had sold off a 42 short put and a 48.49 call spread. We opened this trade on 22nd of January when the stock was trading at $44.72. So we got almost $2.72 on the lower side, did a short put, and then went all the way to $48 and did a $1 wide call spread. For doing this trade, we overall collected $2.85 as a premium. Means if Stone Co blows out of my call spread, it's still no loss because the premium that we have collected is more than the width of the call spread. Now, the stock, when we opened the trade, stock was at $44.72. It's been to different places throughout the duration of a trade, but on 3rd of March, it was again came back very near to where we opened it, $44.26. And during these weeks, it lost a lot of theta. And given what's happening in the market, I thought, let me just close it completely, get whatever profits I can get from it, and let's get out of the trade. It generally, I wait till 50 to 60% of maximum profit, but in this case, I think I closed it just below 50%. Given all the things that are happening in the market, I was happy to close it at whatever profit I could and get out. Alright, so these are the 3 profitable trades on our leaderboard. Let's look at the losing ones. Alright, the first one is again Teladoc. It appears on the leaderboard on both sides, on the profitable sides as well as on the losing side. Now on the profitable side, we saw that we benefited by rolling up the short put. On the Teladoc, I also had a short call spread of $105 and $115 call spread. It was kind of a synthetic covered call because I hold long shares of Teladoc in my long portfolio, and when I opened the trade, Teladoc was trading at $107. So even if it blows through my call spread, means it goes beyond $115, I would still be okay. I am losing on this option trade, but my long portfolio will gain much more than what I'm losing in an option trade. So that's exactly what we did. And as I've told earlier, Teladoc share blew through the roof. It went all the way up to 136, then came back down to $123.70, and the call spread is $10 wide, but when share fell down back to $123.69, there are still some extrinsic value left in it, and I was able to close the trade for $7.77. Could I have waited till the end of March expiry for it to fall down further and maybe it could become profitable? I could have waited. But I think Teladoc is one share which I believe will stay up, and this gave me an opportunity to close the $10 wide spread at $7.77, means lesser loss. So I took the chance and I closed this trade completely on 2nd of March for $7.77. We did 2 contracts, so a loss on this particular, just the call spread, is $678, which is okay. We gained a lot more in Teladoc in my long portfolio. This is one of the best performing tickers for the last 2 weeks in my long portfolio. So the synthetic covered call, it served its purpose. The next one I want to talk about is a trade that we rolled. It's a Roku trade. We have kind of a combination of short put and a short call spread. All right, so when we opened the trade, Roku was right in the middle of around $138, but based on what we have seen in the markets, Roku fell down, and when it came to $110.33, means it was below our short put strike. It was time to manage the trade. So I rolled this short put of $115 from March to April, means I had to close the March trade at $11.34. A lot of extrinsic value still left, but since it has breached our short put strike and also getting closer to March expiration, I thought it is best to reduce the loss, stay mechanical, and basically get more premium and roll it out further to April expiration. If market shows some recovery and Roku goes high again, we'll be able to close this trade at overall profit. If market continues to weaken, we have reduced our loss. So I have rolled this out from March to April. So as a part of a rollout, close the March trade at a loss of $669, but collected more than enough premium to cover this loss for April expiry. The third one I want to talk about is again the similar rolled trade on Medallia, ticker symbol MDLA. We have a short put on Medallia at a strike price of $30. It was an at the money short put that we opened on Medallia on 11th of February, and because of the weakness in the market, Medallia was down to almost $24.28. So on 2nd of March, I rolled this trade out to April, collected more premium, and if Medallia recovers, we'll be able to close it overall for profit. If not, we'll close it at a lesser loss. We'll see it in April. But for now, because I rolled the trade, I took a temporary loss in February of $668, and we'll see what happens in April. I am long-term bullish on this. So if I get assigned at $30 short or strike price, I won't mind holding this and doing a covered call to reduce the cost basis further. All right, now let's look into our last section of our trades, which are the top trades for ranked by premium, the new trades that we opened last week. First one, S&P 500 Iron Fly. So, and the IV on S&P has been really high because of the extreme uncertainty in the market, and I could just not sit on my hands when market is showing such a high implied volatility. So I did two trades on S&P, both Iron Fly. Okay, the one with the top premium is the Iron Fly centered at 297, and the long put at 282, and the long call at 315. So on the put side, the width of the strikes is $15. On the call side, the width of the strikes is $18. I did this trade when the stock was actually trading at $300, but I went a little low and did a Iron Fly at 297 because I wanted to maintain a bearish outlook on the stock. And also because I went little further down and had a little wider call spread, the amount of premium that I had collected is $14.48, and the total width on the put side is just $15. So my max loss on the put side is $52 only, and with the IV so high and with the max loss so low on the put side, I think it was a no-brainer for me to open the trade. Now, if the stock rallies and start to challenge me on the call side and it breaks through my call side, I will lose around $358, but that's okay because the rest of my portfolio will benefit by the rise in S&P 500. I have a lot of other positions in S&P 500 which will be benefited if SPY rise from here. So it will be okay to lose this trade on the call side because it will be compensated by gains on the other positions, and on the put side the loss is very limited, so it was a no-brainer for me. Overall we collected $14.48 as a premium, so it was a huge fat premium. Second trade I want to talk about was a rolled trade that I rolled from March to April expiry in Medallia. We just spoke about when we talked about the losing trade. So like I said, we had to book a temporary loss of $690 or some dollars in April, but we have collected more than that to cover for it in our April trade. So for April, we overall collected $140 as a premium because we rolled the 30 short put from March to April at a huge fat premium. Third one I want to talk about is another iron fly that I had opened on SPY. I opened this one on Tuesday when the markets were actually high. The market was at $305.80. That's where SPY was trading. So we opened a fly at $15 wide, both equally on the call side as well on the put side. So my short call and the short put, it's entered at 305. Long put is at 290 and the long call is at 320. Overall, we collected $12.28 as a premium. That means the maximum loss that I can bear in this trade is $2.72. Doesn't matter where SPY goes, I cannot lose more than this in this trade. With the IV so high and the loss limited to $272, I think I just wanted to get into the trade. So we'll see how these perform in next 2, 3, 4 weeks. Hopefully, if volatility comes back down, we'll see a vol crush and many of these trades will come profitable. All right, so these were the top 3 trades that I wanted to talk about in this session. Let's move on to our next segment, which is mailbag. This is a segment where I answer questions from listeners, from those who write to me on the email or those who write to me on Quora. So the question that I've selected for today's discussion is, how does implied volatility affect options? A very pertinent question given what's happening in the market. The implied volatility has been rising. It's been all over the place in the last week. And if you have been noticing your option positions, you would realize that your option positions have been changing so rapidly. Sometimes it is profitable, sometimes it start to lose. Even though the stock price may not have moved much, but your option prices would have jumped around a lot. And that is because of the impact of implied volatility. Now, I'll briefly talk about how does it impact the option pricing. But I did a podcast on this topic this weekend. So if you want to get into the details of how exactly it impacts, I would request you to head on over to OptionGig podcast and listen to episode number 30. Okay. But just to summarize, higher the implied volatility, higher is the option premium. That is the relation between the implied volatility and option pricing. Why it is like that? It is because if implied volatility is high, that means the expectation is high. That means it is a higher probability that the stock will cross a particular strike price. Say if the stock is currently trading at 100 and the implied volatility is 40, it means there is a 70% chance that the stock would go to $60. But if the implied volatility is 70, then it means it's a 70% chance that the stock could go all the way to $30. Or on the higher side, it you go to $170. Remember, implied volatility does not tell us the direction of movement. It is only tells us the magnitude of movement. It's an estimate of the magnitude of movement. So higher the implied volatility, higher is the movement in the stock, implied movement in the stock price. And that's why higher will be the premium that the traders are willing to pay to protect their investments. So if you see an IV rising in a stock, you will see that the option prices will also rise. It impacts both on the call side as well on the put side. Both option prices will rise. Now the put may rise a little more than calls, but that's a topic of separate discussion. It's called a premium skew, but we can take that in some other session. But just for this one, the impact of the implied volatility is as the implied volatility rise, so does the option premium. So if you are seeing that without the movement in stock, your option trade has gone from being profitable to unprofitable, it is because the implied volatility has gone high and hence the option premium has become more expensive. Alright, I hope this helps you. As always, if you have any further questions and if you're watching this on YouTube, hit me with a comment on the YouTube or send me a note on OptionGig@gmail.com. I also want to point out that in these weekly updates, we only discuss top 3 trades, but as I've shown in the summary, I do a lot more trades than these. So if you want to get a view all of my trades, you can head over to my website optiongig.com/trades and you could review my trades over there. All right, thank you very much for your time. Happy trading, and I'll see you next week. Goodbye. Please note that all the information presented is purely for educational purposes and is not a financial or investment advice. I don't know you, you don't know me, so do yourself a favor and don't invest or trade solely based on what you hear.